Hi, welcome to Chapter 10, Capital Budgeting Techniques. So in this chapter, we're going to talk about key elements of capital budgeting and the capital budgeting process. We're going to learn to calculate, interpret, and evaluate the payback period. We're going to learn the calculate and interpret and evaluate net present value and economic value added, as well as internal rate of return. We're going to use net present value profiles to compare net present value to internal rate of return techniques, and we're going to discuss net present value and internal rate of return in terms of conflicts and ranking and how it's used in practice in business. Okay, so let's start here. So what is capital budgeting? Capital budgeting is a process where corporations look at long-term investments utilizing financial information to select between which investment is best to maximize the company's shareholder wealth. Now, so basically, financial managers have many different avenues for investment. So each investment needs to be reviewed for its potential benefits to the company. Now, companies can't do every investment they come across, so they have to have a budgeting system to figure out where to allocate the capital to the best projects possible. So a capital expenditure is an outlay, a payment of funds from the company that is expected to produce some sort of benefit over a period greater than a year. An operating expense is a layout of funds where the firm results benefits within under a year. So that's the difference between capital and operating expenditures. Now, the capital budgeting process consists of 5 steps. Step 1 is the proposal generation. So proposals for new investment projects are made at all levels within the business organization and renewed by financial personnel. So business proposals could be buying a new company, expanding an existing division, doing research development, buying equipment. These are all different possible investments that can produce wealth for the company. So once the proposals are put together, there's a review and analysis in step 2, where financial managers perform formal review and analysis to assess the merits of each investment proposal. And investment proposals basically have 2 big elements to review: the rate of return and the risk of the returns. So these are the 2 things we want to know. How much money is this going to make us, and how risky is it? Okay, decision making. So step 3, firms have to delegate the capital expenditure decisions based on their dollar limitations. So we learned in last chapter about cost of capital, the weighted average cost of capital. So a firm only has a pool of capital so big that they can put together, and there's a cost to that capital. And they have to look at that in relationship to the capital expenditures they want to make. So if they have a budget, if the weighted average cost of capital gives them a budget of $50 million at a 6% rate, that means that they can only expend up to $50 million. So implementation. Once a project is approved, expenditures are made and the project is implemented, and expenditures for large projects sometimes occur in phases, like you're building a building or expanding a factory. And then the follow-up. Once the results are monitored, actual costs and benefits are compared with those that are expected, and action may be required to tweak or the proposal, or if different outcomes are being realized than the projected ones, there may have to be some changes made along the way. Let's talk some basic terminology. So independent versus mutually exclusive projects. So independent projects are those cash flows that are unrelated to one another. So the acceptance of one does not eliminate the others from being considered. So independent projects mean that they don't conflict with each other. You can accept all of them or none of them, and there's no real connection between them. However, mutually exclusive projects are projects that compete with one another. From the acceptance of one eliminates further consideration of another one. So for example, if you had a plot of land, you may have 5 projects for that plot of land. You can build a shopping mall, you can build a hospital, you can build a jail, you can build a business factory. But once you choose one of those, you can't do all 4. You can only do one. So mutually exclusive means one or the other. It's sort of, you can either build a bridge or a tunnel. But once you build one, at that same site, you don't build another. Okay. Unlimited funds versus capital rationing. So unlimited funds is a financial situation where a firm is able to accept all independent projects and provide that provide acceptable returns. So this is very rare. If a company has unlimited capital, meaning that they could just do whatever they want and accept as many projects as possible. And that's just not realistic, because generally companies that have unlimited capital, or really no company has unlimited capital, but has a lot of capital, they might run into antitrust issues with the government if they're trying to buy too many businesses in one industry. Similar to what Microsoft has encountered. Capital rationing is a more common financial situation where the financial capital of the firm is limited, and they have to pick only a fixed number of projects that will meet but not exceed their capital budget pool. So these amount of projects that they have will have to compete for limited resources of the company. And of course the company wants to select the projects that are most profitable. Now, the accept, reject versus ranking approaches. So there are two approaches. The accept or reject approach, you evaluate the capital expenditure proposals and determine whether they meet the firm's minimum acceptable criteria or they don't. A ranking approach is when you actually rank the capital expenditure projects on the basis of some predetermined measure, such as rate of return or risk or both. So that way, sort of ranking them from the best to the worst. And then you choose, then if you have a capital ration, you choose as many projects at the top best projects that you can with the money that you have. Okay, so capital budgeting technique. So let's go over this. Bennett Company is a medium-sized metal fabricator that is currently thinking about two projects. Project A requires an investment of $42,000. Project B requires an investment of $45,000. The relative cash flows for the two projects will be presented here. So this is Project A and Project B. So this is the cost for A and this is the cost for B. And these are the cash flows that the companies will generate. Notice that this is an even, consistent cash flow, and this is year one gets most of the cash flow and the following years less. Okay, so if we put this on a timeline, we could see that in year zero is the payout. So this is usually thought of as a negative number because we're paying money here. And then here are the cash flows. And you see that this is an annuity because they're even cash flows. Project B, which is $45,000 payout, that we pay to start the project, and then here are the cash flows that we receive for the next 5 years, which is a mixed stream. Okay, so first method, and the simplest method, is the payback method. And this is the amount of time required for a firm to recover its initial investment in the project. And it's calculated from cash flows. So the length of the maximum acceptable payback period is determined by the management. So the management would say, how long is too long? 5 years, 10 years. And if the payback period is less than the maximum acceptable payback period, you accept the project. And if the payback period is greater than the maximum acceptable payback period, you reject the project. Or you could also rank the projects by which project you get paid back the fastest. For example, if you were going to have 5 projects and they all cost the same to invest in, and they all have a similar amount of return, you want to pick the project that returns the most to you the quickest, so you pay off that project the fastest. So again, let's look at Project A and B that we looked at before. And we'll start with Project A, which remember was, if I go back, you'll see Project A. This is the $42,000, is the $14,000 cash flows. Oops. Okay. So, and Project B, which generates the mixed stream of $28,000 up front, $45,000 initial investment in the first year recovers $28,000. And then at the end, then the next couple of years are $12,000 and then finally $10,000. So let's calculate, if we calculate the payback, so the payback period for project, we want to look at Project A and Project B. So let's see where we're going with it. Okay, so Project B, the payback period for Project B, is 2.5 years. So how did we calculate that? We looked at, so for year one, we recovered $28,000 of $45,000. Okay, so then in year two, we recover another $12,000. So that brings us to $40,000 by the end of year two. So then in year three, we're going to recover another At the end of year 3, if the other one has been recovered. So we're going to go recover 10,000, which brings us to 50,000. But we only need, to bring us to 45,000, we only need an additional 5,000. So we really only look at 2.5 years. Now project A is a 3-year payback because the initial investment is 42,000 and we're going to receive 14,000 per year. So if we look at 14,000, if you take 14,000 times 3, you get 42,000. So it only takes 3 years to pay my $42,000 investment back if I'm making $14,000 a year. But for project B, it takes 2.5 years to pay myself back. So the smaller amount of years, the better. Okay, so with the payback period, think of it like this. You're going to buy 2 laundromats. You're thinking of buying 2 different laundromats, but you don't want to buy both of them at the same time. You want to buy the one that can help you pay your money back fastest. So they both cost $100,000. So you borrowed $100,000 from the bank, so you'd like to pay that back as fast as possible. So laundromat A is you're going to see the most of your returns in the beginning of this project because there's no competition around. So you estimate that the first 3 years, you'll pay yourself back in 3 years because you're going to get a lot of return in the first 3 years. But then you figure that another site will probably be built and will cut down on the amount of money you make. But the other example is it's $100,000, but you're going to be earning a consistent, say, $20,000 a year for this foreseeable future. So, but that will take you 5 years to pay yourself back. So now you say that, well, based on the payback model, I should accept the first laundromat with a 3-year payback, even though at the end of 3 years, a big competitor is going to move in next door and steal most of my business. Now the other laundromat, which is $20,000 cash flow forever, it takes you 5 years to pay yourself back, but that's going to be a business that could possibly last 20 years. So even though the payback method says to pick business A because it pays yourself back quicker, it's not always better because business A is going to be out of business in 3 years. So the payback method is widely used by large firms to evaluate small projects, and by small firms to evaluate most projects because it's very simple to use, it's very easy to understand. So it's very popular because how easy it is. However, the goal, I guess, is measured by how quickly you can recover your initial investment and pay yourself back for the money to start the business. So it's more about considering these cash flows, but it doesn't take into account time value of money. And because it can be viewed as a measure of risk exposure, firms with payback periods as a decision criteria or sometimes can be supplemental to other decision techniques. So payback method is the simplest but yet the least accurate method for picking investments to make. So the major weakness is that it's subjective in determining the number. It cannot be specified in light of the wealth maximization goal because it is not based on discounting cash flows to determine whether they add to a firm's value. The second weakness is that it fails to take into account the time value of money factor, and the third weakness is its failure to recognize cash flows that occur after the payback period. And that's what I was saying about the 2 laundromat examples. If you're not looking towards what happens after the payback period, you may pick a business that has a short future over one that has a much brighter future. So the payback period is simple, but weak on a lot of analysis aspects. So the limits of the payback analysis, while easy to compute and understand, the simplicity has those drawbacks. And the weaknesses that we said about not using time value of money and not looking at the future cash flows. I mean, it's a method for evaluating capital projects, but it does not really allow it to be used with more sophisticated calculations. And that's why we want to move into more of a net present value analysis. Now, you can use payback as a point of interest or a point of information, but it shouldn't be used for your full decision. Okay. Now, let's do a personal finance example. So this person is considering investing $20,000 to obtain a 5% interest in a rental property. So this person is in 25% tax bracket. To be acceptable, they're going to require the investment to pay itself back in terms of after-tax cash flows of less than 7 years. So a real estate investment agent conservatively estimates that she should receive between $4,000 and $6,000 per year in the cash flow from her 5% interest in the property. So the calculation flow is the basic payback period, but we're adjusting it for after-tax cash flows. So we're going to take 1 minus the tax rate times the pre-tax cash flow. So the 4 and 6 become 3 and 450. Okay. So if you take the $20,000 investment that they have to make, backing out the taxes from the cash flows, we find that in the conservative view, it will take 6.67 years, and in the optimistic view, it will take 4.44 years for the payback. So because both of these are below 7, she should invest in this property. Okay, so let's look at this enterprise. It's a small medical appliance manufacturer considering 2 mutually exclusive projects, meaning that they're going to do one or the other, not both. So both have an initial investment of $50,000, and here are the operating cash flows from years 1 to 5. The payback period is 3 years for gold and 3 years for silver, so it's even. Now let's look at the payback period for Rashad Company's 2 alternative investment projects. Okay, we have $10,000 here and $10,000 there as the initial investment. These are the operating cash flows. This has a payback period of 2 years, and this has a payback period of 3 years. So here you would say if you're using payback, you should accept this one. But if you look at the future cash flows, even though these cash flows are smaller in the beginning, year 4 and 5 are much larger. So actually you would do better off with picking project Y, which the payback period says you should pick project X, but common sense shows you should pick project Y, which is, a little different than this first project here, because with this first project, the cash flows in later years are identical, but the earlier cash flows are timed differently. So in this project, where the amount of total cash you're getting is equal, so it's 50, 60, 70,000 here, and you're getting 70,000 here, but here you're getting the cash flows sooner than later. So project, even though they're equal, project silver is better. Okay, so let's go into net present value. So net present value is a more sophisticated capital budgeting technique, which we're found by subtracting the company's initial investment from the net present value of its cash inflows, discounted at the rate equal to the cost of capital. So remember, the cost of capital is what we developed in Chapter 9, the weighted average cost of capital. So that's going to be our discount rate. So we want to discount the future cash flows at this cost of capital less the initial investment to see if the project's acceptable. And if the project has, if the net present value is greater than 0, it's acceptable. So the decision criteria: if greater than 0, you accept the project. If it's less than 0, you reject the project. So if net present value is greater than 0, the firm will earn a return greater than the cost of capital and should increase the market value of the company. Therefore, the wealth of the owners will be maximized. So let's look at these 2 projects again, Project A and Project B. They have 2 different initial investments and 2 different sets of cash flow. So we're going to say the company's cost of capital is 10%. What's the net present value of each project? So what we're basically doing is we're taking each of the cash flows. So here we can use the present value of annuity formula. So we could calculate the net present value of all these future cash flows by finding the future value of this annuity. I'm sorry, the present value of this annuity would be $53,000. If you subtract or add to it the negative $42,000, the net present value is 11. If we looked at Project B, each project, since this is a mixed stream, we're going to find the present value of each of the cash flows. So this would be 10,000 divided by 1.10 to the 4th power, and this would be 10,000 divided by 1.10 to the 5th power. And you see that the money you receive in the 5th year is worth less than the money you receive in the first years. Okay, well, let's say year, these are all the three same amounts. You'll see how the money, it becomes smaller the more it is in the future because of the discounting. So if we take our initial investment, we add it to our cash flows, we find that our net present value for project B is $10,924. So therefore we should accept, if they're mutually exclusive, we should accept project A. If they're independent, we should accept both. Now, using a spreadsheet is very useful for calculating net present value. We'll be doing more of this in the spreadsheet problems. So in order to do this, we put in year 0 to year 5. And year 0 is always the payout, which we have to make as a negative amount. And we put the cash flows in, and then we enter in the net present value formula. So hold on, I'll set this up in Excel. Okay, I'm back. It took some time to copy this over into Excel. And if we're going to calculate net present value, we can go to Formulas, Insert Formula, and we want to, under Search, you can put in net present value. Go, and it's right here. Okay. So then the rate would be the cost of capital, and for an annuity, when the cash flows are equal, we can just highlight a range here. And then say OK. Now this is a net present value because I have to also add the cost of the project. So this is a net present value, and that matches, so that's good. Now when you do the mix stream, that is going to be a little bit different. So in the mix stream, you use the same rate, but the values you have to list out separately. So each value is going to be listed separately. And again, you have to also add to it the outflow of cash in year 0. Okay. So here are my two net present value for projects. So which one should you accept? Well, if they're independent, you accept both of them. If they are mutually exclusive, you only accept one of them. So we can do this choice of project down here, which is this formula. You can use, actually, it's called an if statement. So if you've done any programming, an if statement is it's just sort of giving a little logic to the program. So what we're going to, whoops, what happened here? Okay. So if, I'm going to say B11, if this is greater than C11, we're going to say if it's greater than C11, choose project A. If not, project C. Close parentheses. Okay, so what do I do here? If B11 is greater than C11, oh, I didn't get my B. B4 it comes first. Comma. That's better. Okay, so that's a quick way. Let me put this away. So basically, I was just testing this out, and this is a way you can use to calculate net present value, which will become very useful in doing the homework and the test. Okay, so the mathematical formula for net present value is going to input what we call a profitability index, and this is the basic formula. It's what we did up here in Excel, but this is if you want to write it out mathematically, this is how you would do it. And this is the so basically what we want is the profitability index is simply equal to the present value of the cash flows divided by the initial cash outflow. When companies evaluate investment opportunities using the profitability index, the decision rule to invest when the project index is greater than 1. So, for example, in this particular scenario, here's the formula for net present value, but then you divide it by the cash flow. That actually creates a profitability index. So in problem 1, 53,000 divided by 42 gives us a 1.26, and 55 divided by 45 gives us a 1.24. So what does this mean here? So it shows the present value cash flows of project A and B to be calculated using this profitability index for the investment option. So if we go back here, we see that project A has a higher net present value than project B. So here we should accept project A. And project A also has a higher profitability index, slightly higher, And that's just basically restating it in a different way if we wanted to put it in a number. So that way, it's if you had, say, 20 projects to look at and they had different cash flows and different scenarios, it would be a lot of spreadsheet work to look at those. Instead, you could just calculate these profitability indexes for a quicker way to rank the net present value independent projects. Okay, let's talk about economic value added, or EVA. So this is a different way. It's utilizing net present value, but it's a different way of looking at things. And this was created by Stern, Stewart, and Company. So the EVA method begins the same way the net present value method is. We calculate the project's net cash flows. However, with EVA, the approach subtracts from these cash flows the charge that is designated to capture the return of the firm's investors' demand on the project. So, for example, EVA helps to determine the pure economic profit of the project beyond the normal competitive rate of return. So what we're going to look at is, more specifically, the money the project generates versus the cost of the project. So here's an example. So suppose a certain project costs $1 million up front, but after it will generate a net cash flow in years of a perpetuity, which means forever, of $120,000. So the firm cost of capital is 10%. So then the projected net present value in EVA would work out like this. The net present value is project costs $1 million to start. We get to calculate the value of the perpetuity. So we get a value of the net present value would be $200,000. But if we look at the net cash flows in perpetuity of $120,000 each year, less the $100,000 minus $100,000, which would be the cost of that capital, and how we get this $100,000 is the million times 10%. So if we look at it from a cost basis, if we have to borrow $1 million or we're using $1 million of our capital that costs 10%, that's going to cost us $100,000 a year. So if the cash flows, the discounted cash flows, are greater than the cost of the capital, that would say EVA is positive. It gives us an economic value added. Project's also acceptable. Okay, so let's switch over to internal rate of return. So internal rate of return, basically what we're looking for here is the rate. So the discount rate is the rate, we're looking for the rate of that would make the net present value project equal 0. Because if the net project value of cash flows equals the initial investment, we know that we're breaking even. So if it's greater than 0, we're making money. So we want to actually bring the net present value to 0 to see the actual rate of cost for the project, a rate of return for the project. So basically, it's the rate of return the firm will earn if it invests in the project and receives a given cash inflow. Okay, so the criteria: if internal rate of return is greater than the cost of capital, except the project. So here we're using interest rates. So we look at the rate of return, which is expressed as a percentage, in relationship to the cost of capital, which is also expressed as a percentage. So if the internal rate of return is less than the cost of capital, reject the project. So these criteria guarantee that the firm's going to earn money above the cost of capital, and should therefore increase the market value of the company. So what we're doing here again is we don't know the rate of return here. So if we discount, we're looking for the rate that would discount these cash flows to equal 42,000. So at 19.9%, that would be sufficient to discount these cash flows to make forced present value to 0. So that means the rate of return here is 19.9%. For project B, we'd have to have a rate of 21.7% to force these cash flows to a net present value of 0, meaning that the net present value of the cash flows equal the initial investment. So when the net present value of the cash flows equal initial investment, we say that net present value is 0, and whatever rate it took to create that situation is our rate of return. So basically, we're getting a 19.9% return in Project A. Project B, we're getting a 21.7% return. So to find the internal rate of return, we're basically are going to use spreadsheets, and we're going to so we can use the spreadsheets to compare the two projects between A and B, because this is not something you can easily calculate with pen and pencil. So spreadsheets are the best way to calculate it. Now, we already just shown before on that slide that internal rate of return A is 19.9 and B is 21.7. So if we compare the two projects, we know that project B should be accepted first over project A. So, but let's do that and see if we can do that in Excel. So let me bring my Excel sheet back up. Okay, and I'm just going to copy this over. And we're going to relabel this, determining investment rate of return. And as we can see, all of this information is the same, but now what we want to do is we want to change this to internal rate of return. Delete that, and we wouldn't use a new formula, IRR, and we get our internal rate of return formula. So we will put in our values. And hit OK. And let's change this to a percent. So you can see here that it's even easier to calculate internal rate of return than net present value, because you can highlight the whole range of rows. You don't have to add back to year 0 at the end. And if this is, so whether you're doing an annuity or a mixed stream, you can use either method. You can use the same, well actually the same input formula. So you just click the internal rate of return box, highlight all of the cash flows, including year 0, and hit OK. And this will return. So let me just use my format painter to copy that format over. So we got the same results. The if statement will still work, and it's saying here to accept project B. Okay, so that would be in the spreadsheet how you calculate the internal rate of return. And this is what you should be using when you do the homework and also on the test. Okay, so it's interesting to note that the preceding example, internal rate of return, suggests that project B is better than project A, which is the opposite or a conflict in the net present value ranking we obtained earlier. So these conflicts are not unusual. The two methods sometimes produce different results. So if we see here in the spreadsheet, this is where the spreadsheet will kind of pay off now. We have this net present value says pick project A, and determining internal rate of return for project B. So there's no guarantee that net present value and internal rate of return will rank the projects in the same order. However, both methods should reach the same conclusion about acceptability or non-acceptability of projects, as far as are the projects acceptable. So it's really up to management to decide whether or not to use net present value or internal rate of return. Now, if we let me just skip over here. So if we compare, we're going to skip this personal example. If we compare the net present value and internal rate of return techniques, net present value profiles can be graphed to depict the net present value of various discount rates. Now, so to prepare net present profiles for Bennett Company, projects A and B, the first step is to develop a number of discounted rate net present value coordinates and then graph them on the following table. So here is the coordinates for project A and B, a discount rate at 0, 10%, and then 19 and 21. So these are the present values. So at 0, if there was no discounting, this is what the project present value would be, and then discounting at 10%, this is what the present values are, as calculated here. See that 11 and 10, 11 and 10 here? That's where we're getting this 11 and 10. And this 10, the 0% is just saying if you just took the sum of all these, see this 28? It's just the sum of the straight cash flows without discounting. That's how I get 25 and 28. Gets 25, 28 and 25 up here. So if we were to graph them, if we graph project A and project B, the net present value, here is at interest rate 0, and here is at interest rate 10%. And then we could see that as the interest rate moves up, that in anything sort of at 10 and below, we see that project B is not as valuable as project A. But as the interest rate goes up, project B becomes more valuable than project A. And you can see that by the internal rate of return denoting the actual return of the project at the 19 and 20% level. So it's just a way to kind of map out the net present value profile. Okay, now let's go back a bit to talk about what if these two rankings are conflicting. So conflicting rankings, the conflicts in rankings in the project of net present value and internal rate of return result from differences in the magnitude of the timing of the cash flows. Because internal rate of return and net present value are going to look at these cash flows in slightly different ways. So one underlying cause of the conflict is the assumption that the reinvestment of the new cash flows are going to be reinvested at the rate of the project. So cash flows received prior to the termination of the project. So net present value assumes that the intermediate cash flows are reinvested at the cost of capital, while internal rate of return assumes that they are reinvested at the internal rate of return rate. So if we go back to my spreadsheet here, so in here, these cash flows are being assumed to be reinvested at the 10% rate. Over here, when these cash flows are assumed to be reinvested at the internal rate of return rate. So that's why you get a different result, because we're expecting if we get more cash flow in the beginning, this is going to generate more return because we're going to get this 21% on the 28 right away, where it's going to take us 2 years to equal a $28,000 return here and reinvest it. So if you get your money up front faster, like in project B, internal rate of return will value that more because it's expected if the internal rate of return of the project is higher than the cost of capital. If it's lower, it would be the opposite. And that's what thereby where the conflict is evident. Okay. So let's look at this again. So say a project required $170,000 initial investment and is expected to provide cash flows of $52,000, $78,000, and $100,000. The net present value of the project is at 10% is $16,867. Its internal rate of return is 15%. So when we look at table 10.5 on the following slide, it's going to demonstrate the calculation of the project's future value at the end of its third year of life, assuming both a 10% cost of capital and a 15% interest rate. So here, if we look at these three cash flows, now amount of years earning interest. So in year one, we have 2 years earned interest. So in the future value, where we escalate the cash flows by 10%, the future value is only $248. But if we're escalating at the internal rate of return, we get $258. So we note that if the internal rate of return is higher than the cost of capital, the internal rate of return model is going to judge projects where the cash flows at the beginning of the period are greater at the end of the period better than if you just use the net present value approach. So in the future value case, we're viewed that the return in 3 years from today, from the $170,000 investment, then the cash flows would be given in table 10.6 in the following slide. So here are the cash flows. So again, remember, so if we're viewing that we're going to receive the cash in year 3, we're just adding up. So let me go back. So you see this total 248, 258. We're assuming that we're going to receive that in year 3. So this is where it comes from, the 248. So instead of receiving it a little bit each year, like we have here, we're going to say, let's receive the whole amount in the last year. So here we find that internal rate of return here is only 13.5%, and here it's 15%, which makes sense because we're reinvesting at 15% here. So another big reason for why net present value and internal rate of return methods may provide different rankings for investment options has to do with the different timing of the cash flows. So when much of the project's cash flows are live early, the project's net present value will not be particularly sensitive to the discount rate, because it has less years to discount. On the other hand, if the net present value projects where the cash flows, more of the cash flow arrives later, it will fluctuate more because there's more discounting. So the difference in the timing of the cash flows between the two projects does not affect the ranking provided by the internal rate of return method. Okay. So we saw that in Project A and Project B, Project A, Project B, so net present value, pick Project A, internal rate of return, pick Project B. We see that we should, so if R is equal to 10.7, which would be the cost of capital, we should accept the ranking method. So it would rank if R is greater than 10.7. Yeah, what are they trying to say here? All right, so you would rank Project A first, then Project B, I guess. All right, that wasn't the most clearest slide. Sorry about that. The scale problem occurs when two projects are very different in terms of how much money is required to invest in each project. So what if there are two projects, but the cost of investing in these projects are greatly different? In these cases, the internal rate of return and net present value methods may rank them differently. So the internal rate of return approach may favor smaller projects with higher returns, say a $2 loan with a 3% return, and the net present value projects will, analyzing with net present value, will favor investments that make the investor more money, so bigger investments. So for example, internal rate of return just gives you a percentage. It doesn't tell you how big the project is. So if you're ranking projects, and some of them are $1,000 projects and some of them are $1 million projects, that's an important factor to know. So net present value approach is generally favored because it gives you the total dollar amount that the project's going to generate, not a percentage. So if you just get percentages, so I say, which project would you rather have, A or B? A has a 10% return, B has a 15% return. You would say B. And then I turn around and say, okay, B is a $10 project that's going to return $5. And A is a $1 billion project that's going to return $100 million. So now what would you rather be involved with? You see what I'm saying? Size matters, so that's why net present value is generally favored over internal rate of return. So on a purely theoretical basis, net present value is a better approach. Doesn't mean it's always used, but net present value measures the amount of wealth the project's going to generate, and that's why we consider it better. But certain mathematical properties may cause projects to have multiple internal rate of returns, more than one internal rate of return resulting from a capital budgeting project with non-conventional cash flow pattern. So in real life, there are other dimensions to look at, such as variable internal rate of returns for a project. So despite the theoretical superiority, however, financial managers in the business world prefer internal rate of return approach just as often as the net present value method because of the preference for interest rates. So in the academic world, we pretty much agree that net present value is the better approach. But in the business world, sometimes the simplicity of the internal rate of return, where it's just expressing percentages, not total dollars, is favored. Okay. So which method do companies actually use? So this is interesting. They did a recent survey with chief financial officers, and what method they say they use to evaluate capital investment projects. The most popular approaches by far were internal rate of return and net present value, used by 76 and 75% respectively. So internal rate of return is slightly more favored than net present value. So the techniques enjoy a wide use in large firms, with the payback approach being most common in smaller firms. Okay, so let's think about ethics for a minute. Non-financial considerations in project selection. So right now we're just talking numbers about projects and investing in projects. For most companies, ethical considerations are primarily concerned with the reduction of potential risks associated with the project. So, for example, if you're investing in a gambling casino, what ethical risks are that? You're investing in a project that could harm the environment. You can open up the company to potential lawsuits and other conflicts or negativity surrounding the brand. Another way to incorporate non-financial considerations into the capital asset pricing model, project evaluations, and take into account the likely effect that the decisions will have on non-shareholder parties, such as stakeholders, employees, customers, local communities, and suppliers. So what are the potential risks to a company of unethical behavior by employees, and what are the potential risks to the public and stakeholders? So if a company does something that's not favorable to the employees, like increase working hours or make decisions that a project is going to put, that the employees are just not going to like to be involved in, like moving the company from one state to another or one country to another, these ethical considerations have to be thought about. And then when you're talking about the public and other stakeholders, if you're going to damage the brand name or make the company open to riskier products or riskier potential of damaging the environment or hurting people, then even though you might make more money, you still have to look at how it's going to affect the company in in other terms as well. And that's where ethics needs to be married up into capital budgeting decisions to kind of think about, what's the best way of evaluating projects. Okay, so what did we learn today? We understand the key elements of the capital budgeting process. We learned how to calculate and interpret the payback period. We learned how to calculate and interpret the net present value, and we also looked at the economic value added. And we learned how to calculate and interpret internal rate of return, and we learned how to compare that technique to the net present value. And we discussed net present value and internal rate of return in terms of conflicting rankings and theoretical and practical approaches to each of those, and the ethical implications of using only mathematical financial information and not ethical basis in making decisions. Okay, so what you should do at this point, after this lecture is complete, you should definitely read Chapter 10, think about the homework on My Finance Lab, and look at the spreadsheet exercise that comes along with this chapter, and work through the problems in the exercise spreadsheet from what we've learned in this chapter. Okay, thank you, and talk to you again soon.